right, so we talked in the last few sessions about mutual funds and ETFs. And those are pre-built portfolios for you. So we're a company, they divide themselves up into pieces, and those pieces are called stocks, and you purchase stocks, but you're actually building a portfolio of little pieces of stocks. You can also add mutual funds, which is a pre-built portfolio too, or ETFs or bonds, all sort of things. Let's focus on this presentation on session 8 of stocksessions.com on building your portfolio. But think of it like you actually are constructing it. So over the course of your life, you'll change. Your situation will change. Your portfolio should change with you. When you're younger, you're getting your first job. Maybe you start investing when you're in college. Maybe your first investment, most people do this anyway, with a 401k or some type of retirement account with their first job. It's actually a portfolio. So you're investing in a portfolio from a very early age, and your goals are different. You have a whole lifetime to earn money, so you're not, you should not be conservative when you're first starting out. You can be a little more risky. You can hit it rich, potentially. As you retire, you marry and go through life and retire, now you have no job. You're retired. You're living off your savings. You don't want to play risky with your savings, with your life savings. You just don't want to do that. If your portfolio was built like when you were in your 20s and now you're in your 70s, that's a problem. If your portfolio when you're 25 years old or 30 years old is built like you're 85, that's a problem. So match your portfolio with what happens in your life. College, your first job, your second job, your first home that you buy. Maybe you take money out of your portfolio to use for the down payment. That can happen. Marriage, children, retirement, so on and so forth. An illness, a sickness, something takes place. Change your portfolio goals for more income or more opportunity. So you come up the risk, you put more risk on for more profits when you're younger, or you have more money that's disposable, and you can make more if something goes wrong. When you're older, you need to be more conservative because you can't just go out if you lose 25% on a name you thought was going to go up. You can't just go and start working. You're retired. There isn't really a way to make much money, so you have to preserve what you have, protect. So when you're younger, think about growth goals. When you're older, think about protection goals. You can accept risk differently depending on what's happening and where you are. And again, younger investors can tolerate and should, in theory, tolerate more risk than older investors. What should a portfolio look like? So let's go ahead and think of it as what should not. What should a portfolio not look like? Too concentrated, which means a handful of stocks in certain sectors. If you love technology, you love gadgets and goodies and things like that, and so you buy Intel, Apple, Microsoft, all those little tech companies, maybe some ones you might not, or most won't know about, you balance your entire portfolio on those names alone. Well, if they do well as a whole, you do well. But usually what affects one stock affects other stocks like it, and that's why I group stocks into sectors. Potentially that sector could do poorly and your entire portfolio would do poorly. Versus if you spread the stocks around different sectors like financials and utilities and retail, things like that, energy stocks, you would not be hurt as badly if the tech sector goes poorly for a few months, if not a few years. It also should not be too conservative. Really shouldn't be. You never, ever want to see a portfolio stacked with bonds. That doesn't really make sense. It's not a portfolio. It's a bond folio. It doesn't really affect this. It doesn't really make that much sense. It's too conservative. But you also don't want to be too aggressive. You don't want to have all these Netflix-style gains. It could make you a lot of money, but could, like we saw with FXCM or other things like Chipotle, or not Chipotle, with Netflix and Crocs, could collapse. Not something you want to see happen. And a little quote, the unexamined life is not worth living. The unexamined portfolio is also not worth having. We do not want to hold and hope. We don't want to put our head in the sand like an ostrich and just hope that what we made a decision one day or one afternoon or spent 1 weekend thinking about it will be the same for the rest of our life. We don't want to do that. We want to examine our portfolio. And the same thing, we also do not want to have a portfolio that's unadjusted. Same principle, but if you get married, if you buy your first house, if you are fired, or if something happens in the job market and you retire, you don't want to keep your portfolio the same. You don't want to do that. And it's full and exotic and exciting, and those little growth stocks or those names that can be really big wins, those are fun. We talked about bonds being really boring. They are. Bonds have their place. We don't want an entire portfolio of really exciting Netflix-style companies. We saw how big Netflix fell. That can easily happen, and then you're in a bad position. We don't want that to happen. It should be diversified, a little here, a little there, spread the risk around, have different things. It should match your current and future life goals. It should also be balanced between risk and reward, not too much risk, not too much reward. So risk as in taking on lots of things that could give you lots of money, but also security. So I guess balance between not risk reward necessarily, but risk and security safety. A little bit of both. Don't have it all bonds, don't have it all risky opportunity plays. And then the ability to review it and understand it. This is your portfolio. It's not somebody else's. This belongs to you and your family. So your 401k, whatever it winds up being, understand what's in it. If you have an exotic overseas currency ETF, you probably won't know what that is. Most people don't, and that's fine. Don't have it in your portfolio. What happens if you go, how do you know if it's doing well or poor? Well, good or bad? You don't know. Versus Chipotle or Apple, you can figure out if the news is good or bad, the stock price, you can get that and understand and make adjustments if needed. If something goes wrong with Apple and their stock, you can change it versus the Swiss franc ETF. Well, what in the world is that? So, or the Japanese yen or something like that. That's going to be a little more complicated to understand and more factors play with it and play the price of it than just a simple company or gold for that matter, or oil if you don't understand what moves those markets. Make it simple. So include a mixture of bonds, boring, but they exist. It's predictable, like a good friend, always there, like a good dog that you've always had your life. It's always going to be there. It's always going to be loyal and give you money every single year. It's the yield. Stocks, again, there's multiple types of stocks: growth, value, opportunity, income, large, small, etc., young, old, mature. Mutual funds, maybe not. Most people have a portfolio if they go to a financial advisor with these three things. But you can switch this out, and I would recommend this, especially as more ETFs get better and as they are easier to understand and purchase. You can have them switch out mutual funds with ETFs. You'll pay a lower fee. You will not beat the market. You will be the market, and you'll pay less money to do that. I would recommend that, but that's always something that we can decide, or you can decide for yourselves. And so stocks, same thing. Some things that are high risk, and what's an ideal? This is a very complicated answer, but a complicated situation. Let's just say 1 or 2 high risk opportunities if you're young, 0 if you're retired, 1 or 2 high risk, maybe 5, maybe they're about moderate risk, again, depending on your age and your status in life, and then low risk, 5 to 10. A portfolio, if you build it yourself, should be about 20 stocks, 20 to 30, not 80 and not 5. So somewhere in balance. Also balance sectors, technology, healthcare, all the other ones, and then value, which is those things that can really explode and do well or just grow or not. Or the value actually is your established companies at a lower price. Growth is the ones that grow and can explode, like an opportunity, but they may not. So balance amongst all these things. And so that's kind of the general thing about your portfolio as you build. You construct it with just ETFs and stocks, or you could just use ETFs if you wish. So bond ETFs can have a part. They are different than bonds. So there's a lot of ways how they are different. The price will fluctuate, and you may not get your money back, but you will get a yield like you do with the treasuries. Sector ETFs, for example, technology sector, you can do that. Strategy ETFs for growth, value, large, small, other things beyond that. And then individual stocks. You need those because they're fun. They keep you interested and keep you from being bored with your portfolio. Keeps your interest up. It keeps you checking it and reviewing what's going on. You need those to keep your interest in there. And position sizing, this has happened to me a couple of times, a lot of people, where you have a stock that does really extraordinarily well in your portfolio. And when you started, the stock took up about 15, maybe 20% of the portfolio in terms of the value, say $100,000. This stock was about $10,000 to $15,000 when you started. But over the course of 3, 4, 5, 6, 7 years, after it splits and dividends and all the other things, it is the best performing stock in your portfolio, and other stocks may not have done so well. At the end of the day, this stock now is 50% of your portfolio. It didn't start that way, but it grew that way. What do you do about that? That's something you typically should not do. You should not have one stock dominate your entire portfolio, especially as you do over the course of your life, and this will happen. If you do your own portfolio, your own stocks in your portfolio, sometimes there will be stocks that will do really well that will crowd out the other ones. That is inviting too much risk in your portfolio. You don't want to do that. You want to take some of that off the table, take some of the profits, and reinvest into other stocks. Maybe they'll grow, but unless if that one company does poorly, you lost half of your portfolio. Not something you want to deal with. So same thing. So same principles with the review. You can do your own ETFs and stocks, be realistic, and this main idea, you won't get rich overnight with a portfolio well constructed, but you won't lose it overnight either. That's key to it. Stocks typically go about in years are good. Last year was about 13% of the S&P. In the bear market in 2008, it lost about 30 to 40%, the entire market. So generally the average, if you average multiple years, stocks go about 7% per year, give or take, and bonds are typically 2 to 4, give or take. That's what you can expect. Usually less than 10, probably around 5 with a portfolio growth over time. The good thing is that interest will compound, and 5% per year, 10% per year over 20 years, just by the compounding effect, will more than double your portfolio. So that's what's important. A 5% gain 30 years in the future on the same money is different than a 5% gain right now because your portfolio is bigger. Think of that. Einstein called this the 8th wonder of the world. It's called compound interest. That's key to it. And do change your portfolio, but don't check it every single day. That's not what you're looking to do. You don't make positions in and out. You're not a professional with it. Most people aren't, at least. You don't need to look at the market every single day. That's obsessive, and it makes you do bad decisions that are reactive and not proactive or thought out. So it all comes into balance. Risk reward, risk safety versus income opportunity, and then checking it every single day versus checking it never. So balance. The key word for this in building a portfolio is